Investors, in last week's release titled Return to the Old Normal, back to our regularly scheduled program, how the rest of 2024 might play out for the S&P 500, we covered a lot of ground. The equity markets had already been in rally mode for about a week into what turned out to be a bad news is good news, lower than expected BLS jobs release Friday, which was reported at 175,000 jobs, almost 20% lower than economists' expectations. Into that number, the S&P 500 had already rallied about 2%, or 100 cash S&P 500 points off its closing option expiration Friday, April 19th closing low of 49.67. With that bad news is good news attitude, the attitude that the Federal Reserve might cut interest rates sooner rather than later, shorter-term traders had to reverse course, cover shorts, or buy stock backs. Longer-dated interest rate yields fell sharply, setting off what investors should come to expect. Rather, a broad overall market rally led by, yep, you guessed it, the old normal large-cap tech stocks, semiconductor stocks, and some industrial names. The NASDAQ Composite led the rally up, almost 2% on the day. The SMH ETF, that's the semiconductor ETF, was up 2.7%, and almost everything techie jumped between 2% and 8% on the day. It certainly didn't hurt that Apple announced a positive earnings and revenue quarter versus low expectations due to China exposure, and they also announced a $110 billion stock back and teased their entrance into and development of future releases of AI-enabled phone later this year or early 2025. But frequent listeners who know me well know that I like real-time tradable data that leads markets. And I often say that news headlines or government economic data is most often an excuse, or at least a reason given for a move that was highly likely to occur anyway if one looks behind the scenes. Recall just 3 weeks ago, on Friday, April 26th, at the near height of the inflation won't drop and the Federal Reserve might have to raise rates hysteria on financial news networks, our investment team posted our weekly Stock Talk video titled The Good, the Bad, and the Ugly. I drop a link to this video in the description below. In that video, our team called out the good our team was seeing was the real-time data was saying inflation expectations were peaking right then when others were becoming most alarmist. Just 3 weeks ago, the doomsayers were getting most vocal about inflation reaccelerating return. Investors, our scripts are written over the weekend. It takes almost a week for our script to get posted to the internet here on YouTube. That's the one that was penned on Sunday, April 21st. Looking back, that was the weekend the S&P 500 bottomed short term. Investors, that video was taped on Monday morning, April 22nd, and released on Friday, April 26th. Take a look at the updated chart of 5-year real-time inflation expectations. Recall, we had no idea the excuse that might have for a rally, but this real-time data series said one was coming in advance of the current rally in equities. We noted the similarities to inflation expectations late October of 2023, peaking 4 to 5 days before the stock market troughed. Back then, the S&P 500 promptly rallied back to its then all-time high of 4,800 in only 6 weeks. It then went on to go on a 1,100-point rally from the October 2023 low to the March 2024 high in exactly 5 months. The 5-year real-time inflation break-even rates. That was the good news back in late April. We gave you the bad news back then as well. And most likely, the reason for the broad market sell-off the first 3 weeks of April. What was the bad news back then? It was the pivot higher, not lower, in 5-year real interest rates. Remember, investors, this is the interest rate that comes closest to accurately forecasting when their investors are willing to pay higher PE multiples for the market or lower PE multiples. Higher real interest rates historically compress PE multiples, while lower trending real rates historically lead to higher PEs and higher stock markets over the past 15 years. Well, early the week of May 1st, a few days in front of the week Friday's jobs data, our investment team published this updated chart of the real-time real interest rates on LinkedIn. Take a look at the chart we posted with annotations on it. Investors, this was before the jobs data was released, and many strategists and TV personalities were nearing hysterical levels, saying the Fed wasn't going to cut rates in all of 2024, which of course would likely be bad for equities. Why? Because the second half of 2024 looks like there'll be lower earnings than expected, given the economy is slowing, and most of the economic data series are coming in light versus expectations. Here's that same chart of real interest rates 3 days after the jobs data, After the S&P 500 had gained another 1.5%, the growth-heavy NASDAQ rallied 2% on that Friday. Did our team know what the data would be and it would be weaker than expected? No, of course we didn't. Did we survey every state and try to triangulate job creation? Nah, we didn't do that either. There's only 5 of us here on the investment team. We were just looking behind the scenes at real-time tradable data that has been pretty good historically at helping one catch turns or rotate a little more in or out of certain industries and sectors. Why do I say that? Because as soon as the job data hit, you could see the computers take over in buying certain ETFs or stocks with characteristics and selling others. Investors, for example, utilities had been the best performing group in the market in April, along with energy stocks and staple names like Pepsi or Walmart. However, post the jobs data, the energy group was the worst performing group in the S&P 500, and the utility group was only marginally green, even with a big rally in interest rates, which should be a cue to go buy boring and stable companies like utilities and staples. However, computers don't do that. They go buy growth stocks. Over the long term, yes, they work during lower interest rate times. However, when real rates fall, equity risk premium falls, and the quantitative-driven investor kicks in, usually buying the highest growth, most volatile stocks, as they benefit at the margin more from a slower growth economy than more boring dividend growth names. Okay, investors, so where do we go from here? Well, we laid that out in our piece last week. That is in the link in the description below. And investors, I do want to directly apologize to Jerome Powell for one of my last week's comments where I sarcastically mentioned the Fed's collective wisdom. Whether the whole Fed is smart or not, given Jerome Powell's prepared speech and press conference answers after the release of the Fed's decision earlier in the week, I was beyond pleasantly surprised that it does appear that Jerome Powell, if not anyone else at the Fed, is looking behind the scenes and beyond the stale and inaccurate government economic data series. And he's keeping an eye on and taking into consideration real-time market and real-time economic data. Maybe he is watching the Citi Economic Surprise Index go straight down the last 4 weeks as the economic data has consistently underwhelmed the collective estimates of economists and strategists making those predictions. Who knows? We have to wait to see what they do the next couple months. But for investors and retirees uncomfortable with the wider range of possible equity outcomes, the Oak Harvest team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges and shock absorbers for stock portfolios. Information on this exciting new strategy of ours can be found at oakharvestfunds.com. From the whole team here at Oak Harvest, have a blessed weekend. And for you mothers out there, have a great Mother's Day.